Over the last 2 days, we talked about the transformational power of technology, ranging from open banking, next generation payment systems, asset tokenization, DeFi, and much, much more, including AI. For the most part, we've talked about this technology from a safety and efficiency perspective. But technology can do much more than that. It can transform societies and economies. As with most technologies, we hope that technology will be used for good. I'm not sure if that's always true. This is particularly relevant in finance, where there are probably more have-nots than those that have. So I want to take a moment to do an audience survey. How many of you think that the bottom 50% of Americans own more than 20% of America's wealth? No one. What about 10% of the country's wealth? All right, we have at least one person. 5%? All right, a handful. What about 2.5%? All right, a few. What about 1%? Okay. So according to Federal Reserve data, the bottom half of America owns a mere 2.5% of the country's wealth. So some of you guys got that number right. The top 1% of Americans own roughly 30% of the country's wealth. When we zoom out and look at the statistics globally, the bottom 50% own less than 1% of global wealth, and the top 1% own roughly 48% of total wealth. And of course, some of this inequality is attributed to our financial system, where those who do not have resources pay much more in terms of financial services. In America, for example, the most financially vulnerable Americans paid more than $110 billion in interest and fees. This accounts for roughly 20% of the total amount spent by Americans. This afternoon, I am privileged to have 3 thought leaders with us who are working on building an alternative, equitable economy. I'll let our distinguished panelists introduce themselves, and I'll also ask them to share what an equitable economy looks like to them. Let's start with Matt.
Thank you so much. Thanks to the Philadelphia Fed, and thank you to Jalapa for having me. My name is Matt Prewitt. I have been working for about 5 years leading RadicalxChange Foundation, which is a hybrid think tank that experiments with new institutional designs. So we work on voting systems. We come up with better ways of doing voting and collective decision making. We also work on new forms of ownership, new ways of managing data, and not least new monetary systems. And I can say a bit more about our work as the conversation develops. But briefly, my vision for an equitable economy is largely inspired by the thought of a 19th century American economist named Henry George, who had very, very interesting ideas about the sort of sources of wealth and how to share them more equitably. And George's fundamental insight was that the owners of assets are not always the ones creating the value of those assets, and that if we can come up with better ways of understanding the sources of that value, we can actually create more efficient and productive systems. So, for example, unimproved land, the value of unimproved land comes from the community around the land. Well, how can we share that value with the community in order to allow it to, to continue to serve as an input to that economic value? I'll leave it at that, but yeah, I have some largely Georgist sort of inspired vision of economic equity.
Thanks, Matt. Let's go to Robby.
Hey everyone, very nice to be here, and apologies I couldn't be there in person. Very brief background, so Robby Greenfield. I am a been in crypto since about 2011. I'm a Goldman and Amazon alum and was formerly the head of social impact at Consensus, and now run Umoja Foundation, which has put out humanitarian aid-based blockchain products as well as structured finance products. So we've been on both sides of the spectrum in terms of what equity might look like. Very concisely, I think the two things that are happening, and obviously crypto is, the foundation of one of them. I think geopolitics is the leader of the second. The first is that values becoming increasingly localized, to communities who oftentimes aren't the end recipients of it. As earlier said, we oftentimes see markets, and actually Jalapa's paper proves this, where retail is the exit liquidity. This is not only true in crypto, but also in traditional finance. And the kind of counter, revolution, if you can call it that, to that has been things like meme coins or other hyper speculative, tokens that you see in the space that, make many of us scratch our heads until we understand the true intent and reality that retail faces, which is it's probably better to invest in a pump and dump than it is to a slow rug pull if you had to make the choice. And so increasingly we're seeing that, and we're seeing these type of assets get different classifications and be defined in different jurisdictional terms. And I think that that's not something that's just a flash in the pan. I think that will continue and will change value for younger generations quite fundamentally. The second thing is geopolitical trustlessness. As we all know, following the time of COVID, the misuse or overuse of economic sanctions and seizures has effectively split the world in two. We see this with BRICS using Enbridge, trying to create systems in which are not only de-dollarized, but have privatized trade transactions and other currencies, but also how the UAE, Russia, and China have effectively started a U.S. debt offload campaign amidst rate reductions here. And what that means is that countries don't trust the Western banking system as they did before, and that means different types of systems and also different forms of money will come to be used within the global South in contrast to the West. And this is fundamentally going to change what equity looks like, what wealth distribution looks like. Whether it will be completely different on the other side of the world than it is here, I'm not so sure of that. But the fact that it's fractured, I do think will redefine, what new stores of value people trust in, when hard commodities like gold require a custodian that we all trust. Bitcoin may be one of those, but we'll see. That's my take.
Thanks, Robby. Professor Robert.
On mute.
Can you hear me now?
Yes, we can.
Oh, great. And I'm coming through pictorially as well, I hope. I've never used Microsoft Teams before, so sorry. Anyway, thank you all for letting me appear remotely, just like Robby, and thanks very much to Mike Warner and to Jalapa for having invited me into this and organizing this very helpful conference. So just a little bit of background on me, and then a little bit about what I've been sort of pushing of late. Background-wise, I'm the Edward Cornell Professor of Law and Finance over at Cornell Law School here at Cornell University. Previously, I've worked over at the New York Fed and at the International Monetary Fund. Before all of that, and before I actually went into to get a law degree and a business degree, and went on to graduate school and the like, I had my first experience with something akin to community banking when I started what I called a shoebox bank for a group of homeless friends who lived under a bridge. And I was curious at that time, this is some 25 years ago, why it was that they were persistently homeless. And a couple of things that emerged were A, that even though they were very enterprising folk, they did not have any access to banking services, partly because they didn't have addresses. And two, because there was no sort of legal form that gave kind of formal recognition to the kind of enterprise that they themselves had actually formed, which is something akin to an old Israeli kibbutz from, say, the 1950s or 60s. They combined work and life in a kind of communal arrangement and made a good bit of money, but then it tended to burn holes in the pocket. So I started this little shoebox bank for them to enable them to save up, and a few of them were eventually able to pay union dues, in particular to the UAW, and got pretty decent factory jobs in response. So that's what led me to get into finance and to go to law school as well in the first place. And so in a certain sense, my entire trajectory since then has been sort of continued to be prompted by that initial experience. I lived with the guys under the bridge during law school to kind of keep myself honest, so to speak, and I've been pretty much devoted to these sorts of causes ever since. The thing that I guess I've been maybe pushing most lately, and that, if I'm known at all, then the thing that I would be most known for at the moment in the current space is what I've been calling a digital greenbacks plan. And if you were to Google my name and then the phrase digital greenbacks, quite a few things would turn up, number of scholarly articles, a number of columns that I published in Forbes and elsewhere. And then I put out a book a couple of years ago called The Citizen's Ledger. That's essentially a book-length treatment of the same thing. The basic idea is this. A lot of people, nobody here, of course, nobody present in this conference, but a lot of people in the wider world or the wider U.S. are not aware of the fact that there actually is something called Treasury Direct that is run by the U.S. Treasury Department. And per Treasury Direct, anybody who wants to can open up an account with the U.S. Treasury Department and buy and sell U.S. Treasury securities through that account. The only thing that you require if you wish to do that is, of course, some kind of web-based access, be it an iPhone or a smart device or a laptop or what have you. And then also, of course, a bank account, because you're not allowed to hold, Federal Reserve notes as distinguished from Treasury notes in Treasury Direct. So you have to sort of buy and sell between a Treasury Direct account on the one hand and a bank account on the other. It struck me some years back that might be kind of silly because there's no reason in principle why it wouldn't be possible to hold dollars as well as any number of different kinds of Treasury security in a Treasury direct account, so that then you would not actually have to open a bank account with some private sector bank. But instead, what could happen would be the Treasury could actually offer Treasury direct accounts to anybody who wants to open one. And that account could then be used, of course, as a sort of savings vehicle. In addition, though, it occurred to me, why not add interconnectivity or P2P connectivity between Treasury direct accounts so that people could actually pay one another across these accounts as well. And during, of course, the early months of the pandemic, basically January, February, March of 2020, as you might remember, there was a lot of hand-wringing about how to get money out to people, how to get checks to people, particularly if they didn't have addresses or reliable addresses, and particularly if the paper checks might be vectors for the virus. And you'll remember that in the early days, that was thought to be a problem, or that was thought to be a thing as well. So I designed this sort of digital greenbacks plan sort of with that in mind. I thought we could capitalize on the present moment, on the present crisis to make this happen. And so what I did was I phoned up US Digital Service, which, as you guys know, is a fairly lean and mean, newish department within the executive branch of the US government. Obama started it up. It's said to be a favorite of Kamala Harris, and so maybe she would actually expand it if she ends up winning in a couple of weeks. But in any event, what they do, what USDS does, is sort of regularly upgrade the technical capacities, the technological wherewithal of various government agencies and departments. So I phoned them up in late February or early March of 2020, and I told them about this plan, at least this brainstorming idea, and I asked, how difficult would it be, and how long might it take to make Treasury direct accounts, first of all, accessible by smart devices, basically on iPhones or what have you, on equivalent devices, and how difficult would it be to add P2P connectivity, so then basically everybody could save on their phones, so to speak, and everybody could pay and receive payments on their phones. And to my rather immense surprise, USDS said they could probably do that in a few months. In other words, They said before summer is over, before July or August of 2020, they could do this if they were instructed to do it, if they were sort of authorized to do it. So I put this whole sort of plan together, sort of laying it all out, sort of how it would work, and put it out as a white paper, and then expanded it into articles and ultimately into a book and the like. And it seems to have gotten a lot of favorable attention from both Democrats and Republicans in principle, but it just never, I guess, got the sort of requisite political head of steam to be sort of made an actual project of. Just a few advantages that it would offer, and then I'll close for the moment. Of course, as we know, thanks to the FDIC, about 25% of the American population is either unbanked or underbanked. But 95% of the population has iPhones or other smart devices. And so you could actually basically make the or underbanked problem about 1/5 of its current size by doing this. You would also, of course, in theory, be making the economy grow faster, because as we know, GDP is essentially a measure of transaction volume, and transactions, of course, take time. If you could speed up and expedite transacting, then, as this sort of platform indisputably would do, you would have more rapid growth, economic growth. You'd also, of course, have inclusion, something a bit like justice. In fact, I would argue, and indeed I do argue elsewhere, that in a commercial society like our own, or an exchange economy like our own, the capacity to pay ought to be regarded as a public utility. It's a public good, just like the roadways are if your society is an automotive society, or the sidewalks are if your society is an ambular society where people walk. So you basically handle that. You take care of a serious justice problem. You would actually speed up and make transactions more efficient, and hence take care of an efficiency problem. You would grow the economy by growing transaction volume, by making transacting easier and more seamless. You would also open the door for more kinds of things to be paid than can be paid now. For example, certain kinds of care work, like if kids actually tutor other kids at school, or if some kids volunteer to work at to take care of elderly folk instead of having them be in nursing homes. Proof of work type protocols could be adopted so that people could, in effect, certify that they have done these sort of public services, and then maybe federal agencies or state agencies or city agencies could actually partly remunerate people for doing this sort of thing. It would also, of course, be quite advantageous to smaller retailers and smaller businesses. If you talk to anybody at a Duane Reade drugstore in my city of New York, for example, they'll tell you that they highly resent the companies that they have to pay for those card reading and chip reading devices to be used. In essence, there's a tax that's exacted on anybody who dares to access the payment system. And again, a payment system in a society, in an economy like ours, ought to be regarded as a public utility. And this would essentially eliminate that. Finally, it would make monetary policy itself much more easy to effectuate. It would essentially get rid of the leakage that comes with relying on middlemen or middle persons. You would eliminate the old pushing on a string problem that everybody was exercised about when the Fed was looking for ways to stimulate the economy in 2009 and 2010, because all you'd have to do is the Fed could offer interest on these particular accounts, the Fed in conjunction with Treasury, and then they would raise interest rates paid on those accounts. If they wanted people to spend less and save more, they could lower those rates. If they wanted people to spend more and save less, they could even make immediate cash infusions at certain, emergency times, like during the pandemic. All of those checks that were sent out that Donald Trump insisted on the right to sign would no longer be signed checks. They would just be immediate transfers into people's accounts. And if the bankers are upset about it, it'd be easy enough to sort of, I think, buy them off at the beginning, at least, by maybe limiting the total amount. They could be held in an account like this, say no more than $3,000 or $1,000. And it's well known that as soon as people who have been unbanked begin to bank in any particular way, they often move on to use other products as well and go and open other bank accounts as well. So ironically enough, if this pulled enough of the unbanked in, it might actually get existing banks more customers too. That's what I would argue to them. But that's the basic idea that I think Mike wanted me to sort of talk about and why he invited me. Thanks.
Thanks, Robert, and we'll come back to some of the ideas that you raised. Matt, you're working on a number of various topics with different technologies. Can you talk a bit about some of the challenges and benefits of the technologies that you're seeing in the markets that you're working in?
Sure. So in many ways, RadicalxChange Foundation was founded to sort of navigate the help deal with what we perceived as the tension between technological development and democratic institutions. So one example of this, the simplest example of what we mean by that is social media, right? So for example, if you had if someone had told you in 2008 that social media was going to, accelerate polarization and incentivize content that makes people feel fearful and divided and so on, it would have been quite surprising, right? Nobody would have believed that. I think that in some ways, we're sort of in like a 2008 moment now with AI. In other words, I don't know what will happen with AI, but it's possible that it will have very, very disruptive impacts on employment and on people's ability to make a living. And so a lot of our work focuses on how to build institutions that communities can use to provide sort of mutual support in a dramatically changed context. There are many people who take the transformative potential of AI seriously, who think that we'll eventually end up with some kind of UBI-like system. That may or may not happen. I think there are ways that could be good. There are ways that could look quite bad. And some of our work focuses on how to enable people to create their own sort of monetary systems that don't depend on central authority. So we've experimented with blockchain systems for this, but not only. I mean, I think a lot of the work in this area depends on just allowing communities to figure out how to build their own sort of mutual credit-like systems. And in some ways that ends up being sort of like a reinvention of central banking, essentially, which is quite interesting. And our experiments in that area have been quite informative. I think that and yeah, it doesn't always require a blockchain. And I think many of the lessons that we need to learn are sort of orthogonal to the technological medium that we're using.
Thanks. Robby, you're also working on similar projects to develop sort of new stores of value, I think is your term. Can you talk a bit about some of the challenges you're facing in creating this new currency system?
Yeah, I mean, and I can talk to, two different sides or two different extremes in terms of value. I think, to the point earlier made, loan circles or saving circles, which are obviously very common in East Africa and where I used to live in Nairobi in Kenya. We've facilitated systems like that, using blockchain technology and really only using blockchain technology, honestly, as a underlying payment system, something that people know none of the participants were made aware by using it that it was blockchain based, but of course made aware in the context of the program. So, the user experience, didn't require anything different from what they already had, which is typically feature phones like a Nokia or an NFC card. And it's actually very interesting to see how those systems oftentimes, because you have social collateral, right, that is put down, outside of just capital, collateral. Oftentimes the West is highly reliant on how that can increase repayment rates, and also how I think mathematically inclined a lot of these smaller communities are that have employed these type of systems, especially farming communities. I mean, I think the West does a disservice in terms of how we tell the stories of these communities, in terms of how knowledgeable they are. I mean, these individuals, are probably better at day-to-day math than the average American, I'd imagine, just because their life depends on it. You have to understand how much water costs and how much seed costs and, fertilizer, et cetera, and that plays a role into being accountable to those around you. And so you're not going to ask more than, what you need. This can take a tokenized, form, and extend off of mobile money payment systems like M-Pesa and others. And oftentimes I find it's extremely helpful because a lot of those mobile money systems have very exploitative loan systems, right, or loan offerings. The interest rates are usually very, very high. You have micro, lending services that also, exploit on interest rates. And when I say, exploitative interest rates, everyone, I mean like 100+%, right, per year. And you can find, great savings. And then, of course, I think will mature maybe over a decade or so. You can say that there can be an institutional link between a lot of the social funds and these, kind of micro lending systems. So that's one form, and that does have tie-ins with humanitarian aid as well, because a lot of the multinational NGOs have lending programs. The second side that Umoja is focused on now is structured digital assets. So how do you simplify productive money for the common retail investor? Again, the biggest issue that we see both in terms of the ownership of stocks, but also the ownership of cryptocurrencies, is that retail is always the exit liquidity. And what I mean by that, for those who are unfamiliar with that term, is that all the rich people sell out their position, and the people who buy that position are us, and we're like really happy about it, and then everything goes down. And that's typically how it is. And the question is can you make, because a lot of working class individuals or just normal people, right, regardless of the class you have, most people just don't have enough time to become as financially literate as they need to be to catch up in the inflationary environment that we find ourselves in, where it's not good enough to have something that has a 5% APY anymore, right? You're still falling behind. So you now need something that yields 10, 15%, right, to actually save, let alone keep up with costs. And so how do you make more productive money? And what we've been doing is creating structured products based off of Bitcoin. So, looking at liquid staking tokens, or a form of some digital asset being staked somewhere else, and saying, okay, how much yield can we make from this asset in a way that's not, one, considered a security, but two, is globally accessible to individuals to use in a very simple way, which means it needs to be in one form, and it needs to require a very low amount of education to access and to use. And what we found is that the communities that are most open to those forms of assets, which traditionally are only offered to institutions or high net worth individuals, in the stock market, are also individuals from hyperinflationary countries. They're from the Nigerias, they're from the Brazils, right? They're from India, which is very, very interesting to me. And their investment interests oftentimes aligned with the hedge funds in the same industry in terms of where someone can get a principal protected or low risk, high yield investment opportunity. So those are two different sides, of the same coin in terms of, where value can be found on the token side.
Thanks, Robby. Robert, I love your idea of having a digital greenback. We had Franklin Templeton here yesterday. We had Ondo here today. They both offer yield-bearing instruments, right? So in the case of Franklin Templeton, it's a mutual fund. In the case of Ondo, it's a yield-bearing stablecoin. Robert, is there a difference between having sort of this instrument be issued by the private sector versus the government? Robert, I think you're on mute again.
I'm sorry about that. I think there is a significant difference, and it's not owing to anything that the private sector has to be sort of demonized over or sort of criticized for. It's just that the objective function, so to speak, of any private sector entity is of necessity different than that of any public entity, right? I mean, a public entity, for one, wants to avoid loss at most, right? Sort of stay in the black, not go into the red. And there are some circumstances where we're even fine with a public sector entity going into the red if it's indeed, in effect, providing some sort of public good that is not altogether cost-free. But either way, the idea is that profit maximization is not the objective of any particular government agency, whereas it is, by definition almost, right, the primary focus or the goal of any private sector entity, which again is not something we would want to demonize. If we're going to have a private sector at all, or an economy that does involve some space for individual initiative and private ordering and the like, of course, we're going to, recognize the legitimacy of many things being done on the basis of the profit motive. But it does seem also to me, however, that certain things that are essentially public infrastructures should simply not be offered on that basis, right? And it seems to me that indeed, not only should there be quote unquote public options when it comes to these particular realms, but it probably wouldn't be illegitimate just to prohibit the private sector altogether, at least in certain forms, like say private equity firms from some of these. I, for example, don't see why private equity should be permitted to be in the nursing home industry or in the hospital industry, right? Or in the pharmaceuticals industry or in housing, right? A bill that I wrote for Congressman Ro Khanna has just been proposed as of Monday, I think it is, the Stop Wall Street Landlords Act. Originally, I composed that for him in 22. He's re-upping it basically to sort of get them out of there. It seems to me that payment systems are similar, right? That at the very least, you've got to have at least one public option where the profit motive is not sort of determining what happens, where you're basically, again, recognizing that because we are a commercial society, because we are an exchange economy, a mode of payment has to be considered to be a public utility. You might have other private systems as well, just like you have private roads alongside public roads, but you've got to have at least one widely usable public sector rendition of this. And so, yeah, that's essentially why I pushed this greenbacks idea so vociferously.
Thank you, Robert. And unfortunately, we're out of time because I can continue this conversation for another hour. I think one of the key lessons I've learned from the last 2 days is, we talk about technology sort of in the absence of its impact on people and society and economies. And one thing to remember is, as we go through regulations, as we implement technology, as we develop new products and services, it all comes down to the people for which these products are for. I think if we can keep that in mind, maybe we will end up with a more equitable world in the years to come. Thank you to our panelists.
Thank you, guys, so much.